It's important for a trader to be able to adapt and adjust with the markets. This year, 2025, we've been experiencing a lot of volatility. With that increase in volatility, we're seeing large moves and rapid expansions in price action. For the most part, my style of trading over the past few years has been non-directional, which means I trade iron condors, I trade at the money calendar spreads, I'll trade butterfly spreads, iron butterfly spreads. I like to take trades that benefit from being long theta. For example, if the market drops down here and then it bounces, I might think it might consolidate around here for a few days. So I might enter in an at the money iron butterfly, maybe expiring a couple weeks out. And my expectation is that price will just be choppy in between a certain range. If it stays within that certain range, that type of strategy benefits and it leads to a profitable trade. Since the market has been extremely sorry about that, the market just closed. Now, since the market has been extremely susceptible to the headlines pertaining to President Trump and the tariffs, I have had to adjust my approach to trading. For example, when the market is not that volatile, a strategy I like to run is something like a calendar spread. The disadvantage of a strategy like this when the market is making extremely volatile moves is that the break evens, you're generally not going to be safe. As you guys can see here, if the SPX by next week was to go too high up, this strategy will lose. And in the same case, if the market was to go too far down, this strategy will lose. Even if the intention is not to hold until expiration, this is still a box in which we are putting ourselves in. Now imagine if I were slightly bullish, in which I thought the market was going to make a moderate increase in price action over the next few days. I might not want to cap myself and put a risk on the upside. An easy way to make an adjustment with a strategy like this is to turn it into a call diagonal. All you would have to do is push out this contract right here. This is the short strike on the calendar spread, and we are turning it into a diagonal call spread. You guys can see what I just did there is I eliminated any risk to the upside. What this means is if the market was to go up a little bit and kept going past the intended area in which I thought, there would be no risk to a trader, because even if the market went all the way up here, this strategy will still be profitable. What I'm trying to point out to you guys is the fact that you can eliminate risk to a certain side. So in other words, instead of trading a call calendar spread that's slightly bullish, even if you went more aggressive with your speculation and you thought the market was going to make a massive increase of 100 points over the next couple days or into next week, you still have the disadvantage of taking a loss if the market went too far. If we were to bounce over 5% in a week, this trade will be a losing position. And nothing hurts more than when you speculate under direction correctly, but you still end up taking a loss because price action went too far. Last week when the SPY was around 510, right around here, this is when I started to have a bullish bias in the market. This is last week Monday right here. This is about the 510 level on the SPY. I use the SPY and the SPX and the ES interchangeably as I trade all of them. There were a multitude of reasons regarding why I thought the market would make a bounce. To do a quick recap, because this video is not necessarily on this specific trade, I'm just trying to articulate a shift in the approach to how a trader such as myself, which is traditionally non-directional, is adjusting to the current market conditions. Regarding the technical reasons, if you use something like the Fibonacci's, this was a nice 50% retracement right here. This is what's referred to as the golden pocket or the golden zone. Different traders call it a different thing, but for the most part, it is a retracement to the 50% level. So in other words, the market was here, it bounced up to here, and it came back about 50%, and it was right within this range here, which is the 50 to 61% retracement. On top of that, there is a firm understanding of price action. We had a breakdown last week, a consolidation price broke out of this range, it came back, it retested it, and then it bounced again. This was the retracement to this zone. I did a video years ago on the volume profile and the psychology behind what happens. I will leave a link in this description to that video, in which I showcased a similar scenario in which the market was selling off aggressively. I was using the volume profile to articulate what was likely to happen during a situation like that. The volume profile and the ES was also another reason to speculate being long. In Quant Trading app, our weekly level was also down here. This is what's referred to as the Quant Trading app buy zone. It was also letting us know that this is an area in which the trader might want to consider looking to be long. This is just a recap here again from last week. I was targeting the previous week's point of control. The VIX had hit the quant trading app sell zone. So if implied volatility is hitting an expected resistance, then that is a good sign for the market. As implied volatility goes down, the markets generally will go up. Another edge or strong data point was the gamma exposure for last week. So at the start of every week, I like to take a weekly aggregate of the gamma exposure. So say, for example, this week here, I take a combination of all the expirations. So this is Monday, Tuesday, Wednesday, Thursday, Friday. I combine it into a gamma profile, and then I plot these significant levels on my chart, and then I share them with the quant trading app members. So this right here, for example, this is last week. This is the Monday. It's the 17th week of the year. This is Monday as price action is selling off. I put this note on my chart right here that this is a negative GEX roll off below, and then this is a high negative gamma strike. So 510 is a key area in which I'm going to monitor before price action gets there. I'm aware of these levels. Now, I just recall a GEX roll off below, meaning if this is a high gamma exposure node, it just means the gamma just decreases as it goes lower and lower. I interpret that from a gamma exposure standpoint that there isn't a significant amount of interest from a gamma exposure standpoint to keep price either above or below a certain strike. So in other words, if this is a positive gamma level all the way up here, and then I said something like positive GEX rolls off and it decreases like this, that means there isn't that much interest higher above this strike price. Now, if price can rise to the next key gamma exposure strike and hold there, then that means it kind of cleared a specific region. This video is not a gamma exposure video. You can check out my playlist on gamma exposure or check out my main video in terms of how I approach these levels every week. But I just wanted to share with you guys all the things in which I was thinking about last week, Monday, and also being aware of where the gamma flip level was. My expectation was that the market was going to make a reversal and return back to the gamma flip zone within a couple weeks' time. Now, the trade I opened on that Monday is this right here. It is a diagonal call spread. In other words, how this is structured is I bought the 5,400 call. This is 5,400 right here. So this is the level, and this is when I was interested in being long. So as you guys can see here, I was targeting that same level that we saw on the volume profile, the quant trading app sell zone. All the other confluences were up here. I was concerned, however, that if the markets broke out of this level, this is a significant resistance zone for the markets. There was a gap to be filled above, and I did not want to be caught in a calendar spread that if the market bounced and I called a direction right, I would be in trouble if the markets kept going higher. The markets ended up hitting the target within a couple days. In hindsight, it would have been great to just buy the 5,400 call, of course, but I generally will trade spreads. And if I'm just going to buy a call or buy a put, it's generally not going to be on the SPX. I'll reduce the risk by trading SPY options or something like XSP options. If I'm trading the SPX, I like to keep my risk as small as possible, but create asymmetrical returns. The 5,400 call at the time would have been going for $26.60. It's going for $200 right now. That is a massive increase in price. So yes, in hindsight, if I just spent $2,600 to buy this call, I would have only bought one at the time. This would have been a huge return. However, this risk would have been too high for myself. That's why trading something like a call diagonal spread can reduce that risk. This structure here means I'm shorting this call, so the 5405 call, and the cost basis on this was $21.90. The difference between how much this call was sold to open and this call was bought to open is what the debit is. So by subtracting those two numbers, that is the net debit. So this trade cost $470 to open, meaning I can get up to 3 of these to still stay within my risk parameters, which would have been about $1,500 on this trade. I was comfortable with $1,500 in risk with about a 50% stop loss, which is going to be around $750 in risk on the trade, to potentially make thousands of dollars. Now I can scale out. Now that's the other benefit. With something like 3 lots, it means I can scale out of the trade as it works and then put myself in the situation where I can now hold a trade during the week of expiration. As you guys can see, this expires tomorrow with the chance for a possible lotto. If the market was to drop 3.5% tomorrow and close around here, there is room to make thousands of dollars on this trade. However, I am in no pain if the market hovers around here or it keeps going higher, as you guys can see on this risk profile. This is my live risk profile in Thinkorswim. The market is closed, so it's showing a wonky type of risk profile for expiration, which is tomorrow. It's also earnings season. I believe Apple just reported earnings. So strange things are happening, which is why it's a little bit easier to just demonstrate it on option strat. What's even better with a strategy like a diagonal spread is I added another one. So let's actually just take off the original call diagonal. And I want you guys to see this is a call diagonal that I opened this week targeting 56.50. I went a little bit higher just because I liked the price, but 56.50 is essentially the strike that I was targeting for this week. This trade also worked out really well. So this is it right here. And it's essentially following the same logic. At one point yesterday, I think this spread was going for under $3, which would have been amazing to snag some at $3. I didn't get it that low, but nonetheless, it's the same concept. I didn't know how high the market was going to go. Maybe it would have went to 5,700. Maybe it would have went to 5,800. The market is making over 5% moves, so I didn't want to have any type of risk to the upside. So I opened this call diagonal with the same logic. At the start of the week, I did my analysis. I marked down the significant gamma exposure strikes, knowing if the market was to hold above a certain level, specifically 555, it was likely going to want to attempt at 560. 5,650 caught my interest earlier in the week here. So this is on Tuesday, as I took note of the absolute gamma strike being at 650. This is where the current SPX was at the time. This caught my attention. Just tried to share this with the QTA members. Also pointing out, just waiting for a close over this level. The fact that we could not hold above 555 is the reason why I didn't want to jump into the trade too early. This is April 28th, so this Monday right here. Just trying to show you guys, again, the data, so it's not hindsight. This is something we're aware of at the start of the week. If we scroll down here and we say 10 a.m. Eastern time on Monday, what was the gamma exposure profile looking like? We had a lot of positive gamma at 600, and then a lot of positive gamma at 650, with a decent amount of positive gamma also at 700. So if the SPX is here, I'm going to interpret this as long as the market remains in positive gamma territory, this is naturally where it's going to want to gravitate towards. I like that there was an increase as it's growing here. And then I also like that my targets, there was a high amount of positive gamma past my target. That means there is some sort of speculation, something's happening or past this level. Now, I don't know what's going on over here. All I know is that it is higher than where I am targeting, and I interpret that as a good sign. It means my target is relatively conservative. We can actually recreate that graph and take a look at it in greater detail. This is 10 a.m. Let's actually let Quant Trading app repopulate the graph. Let's turn on the absolute gamma and see what it looked like. A lot of positive gamma and a lot of absolute gamma at 600, and then an even larger amount of absolute gamma and larger positive gamma at 650. So knowing this is why I had some sort of bias for the week. Now, usually that can't be the only bias, but when something sticks out that large, I will generally take a risk a little bit prematurely or earlier in the week and then build my positions around that. With no risk to the upside, it means I can comfortably hold the trade. Having the other call diagonal from last week to the downside creates a very favorable structure for myself, and that if the market were to pull back over 3%, there's room for a large win. Now, if the markets by tomorrow went up a little bit higher, there's also room for a large win. There is no risk to the upside. The only scenario in which I'm in trouble is if the market was to be down over 5%. But what will happen in a case like that is implied volatility will skyrocket, and that will also give this spread a little bit more leeway to the downside. And an easy remedy for that is to just keep 30 DTE puts in the portfolio. So always rolling 30 to 45 DTE puts that are maybe another 10% down in the market or so to protect any type of positions. That's risk management, portfolio management, and just hedging. But these trades overall are not using a lot of capital. Under $500 for one lot of this, around $800 for one lot of this. But again, at one point it was going below $3 just yesterday, if I remember correctly, right when the markets dropped down to this significance area here. Again, this is just a break and retest, as you guys can see here. Last week, Monday, I was targeting up here. Price hit here. It consolidated, broke down a little bit, then it broke out. It consolidated, came back, it touched the level, it broke, it pushed a little bit higher, it entered this gap over here, then it broke back down on headlines, but it held this area here. So this is our new baseline or our new support level for the SPX moving forward. I'm not going to speculate or articulate that it's going to go below this, or I'm not going to be bearish now unless we are back in extreme negative gamma territory, which would be if the SPX was below this zone here. But there's likely to be all sorts of supports in this area for now. Hopefully you learned something from this video. Diagonal spreads are something I highly recommend. You don't have to make your structure very expensive. There's all sorts of different ways you can trade these. So for one last example, let's just say you were to speculate that you think the market is going to go down next week. You can use Friday's expiration and then use the following Monday's expiration. And then let's just say you think the market is going to drop all the way back down to 54 to 450 right here. This is what the calendar spread would look like. But then what happens if the market goes too far down? You'll be in trouble. So all you have to do is just push this one a little bit further out than the strike you are purchasing. Once you push it out far enough, it just means it's going to cost a little bit more because you're not collecting as much premium when you trade something like a calendar spread, but that trade-off can often eliminate any risk to the downside, and you can create a nice structure for yourself in which if the market goes down a little bit, you profit. If the market goes down a whole lot, you don't have to worry about being in the red on your on your spread. And if you end up nailing it and the market does hover around the area in which you think it's going to be, you can end up with a extreme win. And if you're completely wrong and the market goes in the opposite direction, it doesn't necessarily matter because you have an asymmetrical situation on your hands in which if you are right, you make a lot. If you are wrong, you only lose a little bit. That means your win rate can decrease, your accuracy doesn't have to be that high, but you can still be profitable, presumably over the next 3 years with the current presidential administration. We can expect a lot of volatility. This is an adjustment that I have made to my trading. Thanks for watching, guys. If you're new to the YouTube channel, subscribe, like the video, leave a comment if you learned something. Thanks for watching. I'll catch you in the next one.